Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Walmart.
If you find our talks useful, please consider subscribe, like, and comment underneath. All right, let's be honest here. Usually when we sit down and talk about, trillion-dollar valuations or AI revolutions or stocks rallying 30% in a quarter, we're talking about Silicon Valley.
Right.
We're talking chips, cloud computing, software. We're usually not talking about Bentonville, Arkansas.
That's the traditional view, yes. But the market has a funny way of surprising us.
It certainly does, because today we are looking at a company that is basically the definition of brick and mortar. Yet somehow they've pivoted so hard they're starting to trade and act like a tech giant.
Exactly. And the big headline here isn't just about groceries or rollbacks. It is about a massive milestone. Walmart has officially hit a $1 trillion market cap.
$1 trillion. That is a very exclusive club, usually reserved for the Apples and Microsofts of the world.
It is. And recently it's been hovering right around 1.7 trillion. And what's fascinating to me isn't just the number, but the momentum. This stock isn't moving like a defensive utility or some boring grocer anymore.
No.
It's moving with velocity.
Right. I was looking at the charts before we started. This thing is rallying like it just announced a breakthrough in quantum computing or something.
It essentially is. I mean, that's the kind of sentiment it's rallying on. Even if the underlying business is selling, bananas and T-shirts, shares have rallied about 30% in just the past 3 months.
30%?
Leading up to this fourth quarter. And if you look year over year, they're up 28.7%.
Which I assume is just crushing the broader retail industry.
By a significant margin. The industry is sitting at around 27.9%, so they are outpacing their peers. But more importantly, they are decoupling from their traditional rivals. And this brings us to the core narrative shift.
Okay.
The market is effectively re-rating Walmart.
When you say re-rating, you mean investors are willing to pay more for every dollar of earnings than they were before.
Precisely. They're moving it from the traditional retailer bucket, that old blue vest image, to a high-tech platform bucket. The market is starting to see them as an omnichannel AI-driven powerhouse.
That is a huge claim. I mean, I still go there to buy laundry detergent. It feels like a store. It smells like a store.
Yeah.
So let's unpack the fundamentals. Is this tech valuation actually backed up by the numbers, or is this just hype?
The numbers are definitely there to support the growth story, even if the valuation is getting a little steep. Let's look at the revenue health first. The top-line revenue for the trailing 12 months it's colossal. We're talking $703.6 billion.
$700 billion. That is effectively the GDP of a mid-sized European country.
It's massive. But scale alone doesn't get you a tech multiple. You need growth. So if we look at U.S. comparable sales, which is the key metric for retail health.
Right. It strips out new stores.
Exactly. Excluding fuel, they rose 4.5% in the third quarter of fiscal 2026.
And 4.5% for a company of that size is actually
huge.
Moving the needle a lot. It's like trying to turn an aircraft carrier like a speedboat.
It is. And here's where it gets really interesting. It's how they're growing. In retail, you always look at the split between ticket and traffic. Are people just paying more, or are more people actually coming in?
And ideally, you want both. But usually in this economy, you see traffic drop while prices rise.
Exactly. But Walmart has both. Transactions are up 1.8%, so more people are walking through the doors or, clicking buy. And the average ticket is up 2.7%. They are winning on volume and they are winning on price.
That's a very difficult combination to beat.
It really is.
Okay, so people are shopping more and buying more when they do. But you mentioned this tech argument, the e-commerce explosion. For years, the knock on Walmart was that they were a dinosaur and the online giants were going to eat their lunch.
That narrative has completely flipped. This is the key argument for that premium valuation. Their global e-commerce sales surged 27%.
27% on a base that big that's impressive.
And in the U.S., it was up 28%. But here is the statistic that I think really matters. This isn't a one-quarter wonder. This is the 7th straight quarter of growth above 20% for their U.S. e-commerce division.
7 quarters. That's nearly 2 years of consistent 20+% growth. That tells me this isn't a pandemic fluke. This is a structural change in how they do business.
It is. It shows they figured out the logistics. And speaking of logistics, get this. This is the stat that blew my mind. 35% of store-fulfilled U.S. orders are being delivered in under 3 hours.
Under 3 hours. That's faster than pizza delivery used to be.
It is incredibly fast, and think about the implication of that.
Well, it's the ultimate convenience.
Yeah.
But it also speaks to their network, right?
It's their counter-positioning against the pure online players. Instead of building massive warehouses in the middle of nowhere, Walmart is using its 4,000-plus stores as mini fulfillment centers.
They're closer to the customer than anyone else.
Exactly.
So that is the tech play. That isn't just having a website. That is having a supply chain algorithm and a fulfillment network that rivals the best in the world. They turned their biggest liability, all that physical real estate, into their biggest asset.
It turns every supercenter into a distribution hub. That's the efficiency engine. And that bleeds down into the margins. You might think growing that fast online would hurt profitability because shipping is, notoriously expensive.
Right, usually e-commerce dilutes your margins. You have to pay for the van, the driver, the gas.
And yet their net margin is holding at 3.26%. They recently reported earnings per share of 62 cents, which beat estimates. But what's keeping the traffic high is their pricing power. They currently have 7,400 active rollbacks.
Rollbacks meaning price cuts.
Yes. And over 2,000 of those temporary price cuts have been made permanent.
That is a strategic weapon. In an inflationary environment where everyone's feeling the pinch, Walmart says, we're lowering prices. That has to drive loyalty.
It does.
But how do they afford that if they're also spending money on fast shipping?
And this is where the business model gets really sophisticated. It's the advertising revenue.
Ah, right, the ads.
Walmart Connect, it's their digital advertising business. And it is growing fast. Think about it. They have the traffic. They know what you buy. So brands are willing to pay a premium to show you an ad right when you're searching for toothpaste.
It's the classic high-margin business hiding inside the low-margin retailer.
That's it. And the potential integration of Viz.io is going to accelerate that even further. They're building a whole media ecosystem. That high-margin ad revenue subsidizes the low prices on the shelf and the cost of the fast shipping.
So the fundamentals look robust. The ecosystem is feeding itself. But now we have to talk about the price tag. Because you can have a great company, but if the stock is too expensive, it's a bad investment. With $1 trillion market cap, the multiples have to be getting stretched.
It is expensive. There's no way around that. The forward PE, the price-to-earnings ratio, is sitting at 45.33.
Whoa. Okay, hang on a second. 45. That is high. That is tech high. That's the kind of multiple you see on a software company growing 50% a year, not a grocer.
It's a massive premium. For context, let's look at the competition. Target is trading at a PE of 14.86.
Ouch. So Walmart is 3 times as expensive as Target on an earnings basis. That is a massive divergence.
Correct. But then you look at Costco. Costco has always commanded a premium because of its membership model, its consistency. Costco is trading at 48.4.
So Walmart has graduated. It's no longer being valued like Target. It's being valued like Costco.
Exactly. The market is saying Walmart is closer to Costco in terms of quality and reliability than it is to Target, which has been struggling with inventory and consumer trends.
But what's the moat here? Why does the market think it deserves that Costco-level premium? Is it just the e-commerce?
It's the inventory discipline and the demographic shift. This is really key to understanding the risk reduction here. Inventory is a killer in retail. If you have too much stuff, you have to mark it down, you lose money. Walmart's inventory is up only 3.2% overall, and in the U.S., it's only up 2.6%.
And remember, sales were up 4.5%, so sales are growing faster than inventory.
Exactly. They aren't stuck with unsold goods. Compare that to some competitors who are drowning in excess stock. But the other side of the moat is who is shopping there now. They are gaining significant market share among upper and middle income shoppers.
The trade-down effect.
Right. People who might usually shop at specialized retailers or organic markets are coming to Walmart for the value. But, and this is the important part, they're staying for the convenience, for the tech experience we mentioned.
So they come for the cheap eggs, but they stay because the app is good and the delivery is fast.
Precisely. And this offsets the pressure on the lower income consumer who might be pulling back on discretionary spending. It gives them a much broader base.
Okay, so we have a transformed business model, a very rich valuation, a strong moat, but we're a trading show. We care about what is happening now. What's on the catalyst calendar?
Well, the most immediate event is literally tomorrow.
February 19th, 2026.
Fourth quarter fiscal 2026 earnings. This is the big show.
What are the expectations? Because with a PE of 45, the bar must be incredibly high.
It is. The street is looking for earnings per share between 60 and 72 cents. And for those comparable sales, the comp's expectations are for a jump of 4.3 to 5.0%.
So they need to hit those numbers just to justify the current price.
It's a high bar. Piper Sandler and BTI are actually predicting beats, specifically driven by that e-commerce strength and the ad revenue we talked about.
Okay.
They think the street is still underestimating the momentum.
Are there any specific factors we should be listening for on the call, apart from just the headline numbers?
The weather.
The weather. Really?
Specifically, winter storm fern.
Ah, right. I remember seeing the maps for that.
It might sound minor, but severe weather drives grocery sales. People stock up. It's the classic bread and milk panic buy. It's a potential specific driver for late Q4 sales that might just push them over the top.
It's funny how a trillion-dollar company can still be swayed by a snowstorm.
It's the reality of retail. But more importantly than the weather, investors will be listening for guidance. The projection for next year is an EPS growth of 11.5%.
Double-digit earnings growth for a company this size is impressive.
It is, and honestly, it's necessary. If they confirm that guidance, it justifies that PE. If they guide lower, even by a little, that valuation starts to look very stretched very quickly.
Which brings us neatly to the risks. We have to look at the bear case. You mentioned the PE is 45. That implies perfection, doesn't it?
It does. That is the biggest risk. Valuation stretch. When you're priced for perfection, any slip-up, a slight miss on comps, a slightly cautious guide, and the stock can drop fast. There is no margin of safety at these levels.
And macro-wise, we're hearing a lot about tariffs, consumer pressure.
Tariffs are a headwind, certainly, given how much they import. And there is always the concern about the lower-income consumer cracking under inflation.
But the counter-argument,
Yeah.
and I feel like this is what the bulls are betting on, is that Walmart is the ultimate defensive play.
That's the priced-in argument. The market seems to believe that Walmart's scale allows them to absorb tariffs better than anyone else.
They can squeeze suppliers.
Right, they have the leverage. And if the consumer cracks, well, they just shop at Walmart more, not less.
If you're broke, you don't stop buying food, you just buy it where it's cheapest.
Exactly. Their inventory discipline and those 7,400 rollbacks put them in a position to absorb macroeconomic shocks better than, say, a Target or a department store. They are the predator in this environment, not the prey.
It's a compelling setup. So let's wrap this up. We've got the trillion-dollar milestone, the tech transformation, earnings tomorrow. What's your final verdict?
I'm giving us a bullish score of 8 out of 10.
An 8. That is confident, especially with that valuation concern.
It is. The transformation is real. The 28% e-commerce surge and the 4.5% comps are the proof. This isn't just a narrative, it's execution. They've successfully cemented their status as a tech retail hybrid.
So what's the strategy here for the listener?
I view this as a buy for resilient growth. You're buying the evolution into an AI and omnichannel powerhouse. The target horizon here isn't a quick trade. It's a multi-year hold into fiscal year 2027.
Riding that double-digit earnings growth and the ad revenue expansion.
Exactly. Even with the risks, this is a company firing on all cylinders.
Well, there you have it. The blue giant is dancing like a tech startup. Earnings are tomorrow, so keep your eyes on the wire. We will be watching to see if Winter Storm Fern and the e-commerce engine deliver the goods. If you found this breakdown helpful, don't forget to subscribe and leave us a comment. For Smart Wealth with Joshua, thanks for listening.